G'day Gain Squad, I am so stoked to have you here for another massive deep dive into the financial chaos. Let's see why we call it smart money as we unwrap the ultimate tell-all story of a Wall Street titan. Today, we are tracking the rise and fall of Bear Stearns, starting from its scrappy roots to its total obliteration. We'll expose the lack of audits, the shocker of the one-account scandal, and how they gambled with all their clients' funds. Plus, we are fast-forwarding to 2026 to see if our current AI bubble is just 2008 in a wig. Just a quick heads up, traders, this isn't financial advice, so don't go betting your rent money based on a video. So here is the big question for the day. Are we living through a high-tech replay of the greatest credit collapse in history? Tell me your thoughts in the comments, smash that like button, and subscribe so you can join our circle of goal-getters. Let's wind it back to 1923 when Bear Stearns kicked off with just $500,000 of capital. They weren't your typical silver spoon bankers. They were outsiders who survived the Great Depression when everyone else was cooked. The culture was set by Alan Ace Greenberg, a bloke who hired people with what he called PSD degrees. PSD stood for poor, smart, and a deep desire to be rich, because Ace wanted hungry traders who knew how to hustle. He was notoriously tight, sending out memos about reusing paper clips, while the firm was clearing millions in profit every day. Bear became the go-to firm for the big names, including the Sultan of Brunei and even Donald Trump back in the day. They were the mavericks of the street, famously refusing to chip in for the rescue of a massive hedge fund in 1998. That move saved their cash, but made them some very bitter enemies among the other big banks and the Federal Reserve. But as the firm grew into a bond trading juggernaut, the focus on risk management started to slip through the cracks. It was the beginning of a shift from street-smart survival to high-stakes gambling that eventually brought the whole house down. Enter Jimmy Kane, a professional-level bridge player who took the CEO chair in 1993 and led with massive ego. Jimmy was the first Wall Street boss to hit a paper net worth of $1 billion solely through his own firm's stock. But while the subprime mortgage crisis was brewing in 2007, Jimmy was basically out of the office. He was flat out playing in bridge tournaments in Memphis and Detroit while his traders were drowning in toxic debt. Reports even surfaced that he liked to smoke a bit of pot in hotel bathrooms during those tournaments while the market froze. He was checking in by phone on Fridays from the golf course, totally disengaged from the systemic risks on the balance sheet. It was a proper leadership vacuum at the worst possible time, leaving the firm's strategy in the hands of disengaged execs. This gambler's swagger meant they treated the subprime mess as a competitive edge instead of the ticking time bomb it was. When the tide started to go out, Jimmy was still at the card table, unaware that the beach was about to vanish. By the mid-2000s, Bear was the king of mortgage-backed securities, bundling up dodgy home loans and selling them for billions. Their internal hedge funds were using leverage as high as 100 to 1, which is absolutely mental if you think about it. Leverage that high means even a tiny drop in asset value can wipe out the entire fund's equity in a heartbeat. In 2007, two of their biggest funds collapsed, which was the first real sign that the game was up. But instead of coming clean, they doubled down, trying to pretend these toxic assets were still worth 100 cents on the dollar. Smart money like Ray Dalio saw the disaster coming a mile away and started pulling back as early as 2006. Dalio warned the Treasury that the big banks were insolvent, but they were all too busy riding the housing high to listen. The firm's reliance on the repo market meant they needed billions in fresh cash every single night just to keep breathing. Once the market realized the collateral was garbage, those lenders stopped picking up the phone, and the air just ran out. Now, let's talk about the absolute dumpster fire that was the internal accounting and the infamous one-account scandal. Legal filings later alleged that Bear Stearns was commingling client funds into a single composite account instead of keeping them separate. This meant that when the liquidity dried up, clients found it nearly impossible to claw their money back from the mess. There was a massive lack of audits and transparency, with regulators later claiming the firm omitted huge delinquency data in their prospectuses. They were basically putting a designer suit on a pile of sludge and telling everyone it was a AAA rated investment. Their auditor, Deloitte, ended up settling for $19.9 million over claims they signed off on misleading financial statements. It was a classic case of the gatekeepers being asleep at the door while the looters were busy clearing out the vault. Traders were misled about the true quality of the loans, which were actually more than 30 days delinquent at the cutoff date. This lack of segregation and oversight is a massive red flag that every investor needs to watch out for today. If you can't see exactly where your funds are held and how they are audited, you might be in a one-account trap. The final death spiral happened in March 2008, and it was the fastest collapse Wall Street had ever seen. On March 11th, Jim Cramer famously yelled on TV that Bear Stearns is fine and told people not to move their money. 6 days later, the stock had crashed 90% and the firm was being sold off for the price of a coffee. The Federal Reserve brokered a shotgun marriage with JP Chase for just $2 a share to stop a global meltdown. Imagine being a lifer employee with $200,000 in your retirement fund and seeing it vanish to $2,000. Warren Buffett sat on the sidelines, waiting for the rain of gold to hit the floor before he stepped in to provide capital. Buffett didn't want to bail out the reckless. He wanted to buy the high-quality wreckage once the panic had settled. It was the end of an 85-year legacy, wiped out in 5 days, because they forgot that liquidity is the invisible oxygen. The market's having a bit of a wobbler today, thinking about those days, but the lessons are as fresh as a Sydney morning. History doesn't repeat, but it definitely rhymes, and that rhyme is getting very loud as we look at 2026. Fast forward to right now, April 22nd, 2026, and we are in a massive AI supercycle. The S&P 500 is pushing toward 7,500, and everyone is frothing over the latest chip technology. Nvidia is the current star of the show, with a market cap that recently hit an astronomical $5 trillion. Their stock is trading around $202.34, and the FOMO is absolutely real for many. But we are seeing some familiar patterns in how this growth is being financed and how the profits are being booked. The market's having a bit of a wobbler because people are starting to ask if these valuations are based on real productivity. We are seeing massive concentration, with only a few mega-cap names holding up the entire weight of the global indexes. If one of these giants trips, the whole market could face a 10% correction that triggers massive algorithmic selling. It's a high-stakes game of musical chairs, and we need to look at the circular funding that is keeping the music playing. This brings us to the Great Loop, a reflexive funding structure where tech giants are essentially buying from themselves. Microsoft and Google invest billions into AI labs like OpenAI, who then spend that cash back on Microsoft's cloud services. It's basically revenue round-tripping. They provide the capital that eventually flows back to them as reported AI revenue. This inflates the earnings and drives the stock prices higher, creating a financial mirage that looks like explosive growth. Nvidia has even invested billions in its own customers to ensure they keep buying the chips that fuel the whole ecosystem. Analysts are calling this a financial Ouroboros, where the same money cycles through a closed loop to prop up valuations. The warning signal is the return on invested capital if the end users don't start making money. The circularity will break. We are already seeing capital expenditure fatigue on investor calls, as Wall Street starts asking tough questions about actual ROI. If the software adoption doesn't catch up to the massive infrastructure spend, the Great Loop is going to snap very hard. Let's compare 2008 to 2026. The names have changed, but the mechanics are identical. Back then, it was home prices never go down. Today, it's AI growth is infinite and non-optional for every business. In 2008, the leverage was in the repo market. Today, it has migrated into the shadow world of private credit. Private credit has grown to $2.5 trillion, with a huge chunk of that exposed to risky software and AI. The US private credit default rate hit 5.8% recently, the highest level since they started tracking the metric. Just like the mortgage-backed securities, these private credit deals can be opaque and very difficult to value in a crisis. We have a single point of failure, where the global economy is banking on just 2 or 3 companies to save the day. If the AI revenue doesn't manifest soon, the lenders will pull back, and we'll see a liquidity squeeze just like Bear Stearns. The psychology is the same: total euphoria followed by a sudden, heart-stopping realization that the math doesn't work. Leverage is the silent killer, and while the banks have more capital now, the corporate sector is more indebted than ever. Since 2008, the world has added over $50 trillion of new debt to the global pile. Emerging markets are struggling to service that debt as the US dollar stays strong, creating a global pressure cooker. High oil prices are the lunatic indicator right now, trading over $100 a barrel and squeezing margins. Data centers eat energy for breakfast, and if power costs stay high, the AI revolution is going to get very expensive. When the smart money like Warren Buffett and Ray Dalio starts moving to cash, you know the cycle is near the top. They are waiting for the swimming naked moment when the tide finally recedes and the real value is revealed. Let's optimize this entry by looking at the technicals. Nvidia's trailing PE ratio is currently sitting around 37. While that's high for a titan, it isn't as crazy as the dot-com era, where some companies hit over 100. However, the forward PE of 21 assumes that Nvidia will capture almost all global capital expenditure in the near future. We are seeing a slight decrease in gross margins, from 75% down to 74.8% this year. This stabilisation suggests the market is shifting from a seller's market to a buyer's market with more hardware options. On the charts, a 10% drop would breach key technical support levels and likely trigger a wave of algorithmic selling. Keep an eye on the Aussie dollar pair as well, as currency volatility often precedes a major shift in global risk appetite. This is a proper golden entry for anyone looking to understand the math before the market takes a proper dive. So, how do you protect your gains, gold getters? First, you need to anchor your portfolio in contractual income. Look for mature, dividend-paying businesses that have proven they can generate cash flow even when the hype dies down. High-quality fixed income with yields of 6 to 7% provides a margin of safety that was missing for decades. You should also diversify vertically into real assets like gold, energy infrastructure, and commodities that hedge against inflation. This is a proper golden entry into a more defensive strategy that doesn't rely solely on stock market multiples expanding. Maintaining a liquidity buffer in short-term treasuries is the most important move you can make right now, hands down. It gives you the wash tub to catch the gold when the market finally has its inevitable crash and assets go on sale. Avoid the temptation to chase the moon in pre-revenue AI startups that are just burning through their venture capital. Check your counterparty risk, know exactly who is holding your funds, and make sure they aren't commingling your assets. 2026 is a market for investors, not gamblers, and the difference is a solid plan for the downside. We also need to keep an eye on the great fragmentation as supply chains move into competing global blocks. This means resilience and security are becoming more valuable than just pure efficiency and low-cost production. Sectors like defense, healthcare, and materials are looking attractive because their demand isn't tied to the AI narrative. Ray Dalio's principle of diversifying well is the only free lunch in finance, so don't put all your eggs in one pouch. If the US dollar starts to surge, it will punish companies with international debt, so watch those balance sheets closely. Be ready to pivot fast when the narrative shifts from growth at any cost to show me the actual money. To wrap up, Bear Stearns collapsed because of extreme leverage, disengaged leaders, and a total failure of internal audits. The one account scandal showed that even big names can play fast and loose with client funds when they are desperate. The 2026 AI bubble is using circular funding and round-tripping to create a financial mirage of growth that might be unsustainable. Private credit is the new subprime, with default rates rising and opaque valuations masking the true systemic fragility. To stay safe, you need to focus on high-quality income, real assets, and keeping plenty of cash dry powder ready. Don't let the FOMO cloud your judgment. The math always wins in the end, regardless of how transformative the tech is. Liquidity is king, and those who have it when the tide goes out will be the ones buying the future for a pittance. Now, I want to hear from you. Do you think the Great Loop is about to snap, or can AI productivity outrun the debt? Tell me your predictions in the comments below, and let's get a proper debate going in the squad today. If you enjoyed this forensic deep dive, thump that like button and subscribe for more golden insights on the market. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!